Okay, so welcome everybody to the first episode of UnPACing Alpha. I'm Sebastian Lander, Portfolio Manager at PAC Capital.
And I'm Camilla Goldingay, the Business Development Manager at PAC Capital.
And we have Ross Cameron with us from Northcape Capital. Thank you, Ross, for joining us.
Thanks. Very, very good to be here.
Brilliant.
So I'll kick it off. So tell us, Ross, who are Northcape Capital and what role do you play at Northcape Capital?
So we are long-only equity managers. The firm was started about 2004, so we've been going a long time. There's, across all of the products, are the things that define us. We're multi-portfolio manager, so we think that's the optimal way of managing money. All of our funds are long-term focused, so in emerging markets, for example, our average holding period is more than 3 years. We tend to run concentrated portfolios, same in emerging markets. So if you think of EM as 25 countries, it's half of global GDP and more than half of the world's population, we're running a portfolio of about 30 names, the really best ideas. So this is consistent across all of Northcape's products. It's 100% owned by staff, so it makes us fiercely independent. I joined in 2009. And I'm a portfolio manager on the Emerging Markets Fund, which is now a bit over $5 billion. And we've seen, since that inception, if you think, so my colleague Patrick Russell started the fund on the 1st of July 2008, which was an inauspicious time to start a fund just before Lehman Brothers and so on. So since then we've seen the Lehman crisis. We've seen the taper tantrum in 2013 had a big impact on emerging markets. We've seen the election of President Trump, 2016, a once-in-a-century pandemic, which we're still in, arguably now, and, of course, the Ukraine invasion last year. So we've seen all kinds of external shocks over that period, and the funds generated good performance across all kinds of external environments.
Brilliant. And your track record, you sort of alluded to it there, but your track record is sort of second to none in this space. And again, you sort of touched on some of the points that I imagine speak to your edge. But maybe you could just give us a couple of minutes on why you think Northcape has done so well in that space compared to peers.
So I think our fund structure gives us a big advantage. There's obviously lots of smart people in emerging markets trying to find stocks, but what tends to happen if you're running an emerging markets fund in a bank or in a listed company, you become what we call an asset gatherer. Right. So your business model is to run as much money as possible under management, and that's how you drive revenue. And that's why Northcape has always been, since inception, and will continue to be, privately owned with 100% ownership by current staff. So the way that we structure the business is when people retire, they sell their equity in the business. So the shareholders are all people now in the business working together to generate this performance. What that means is we can cap the fund at a much more conservative level of capacity. So golden rule of investing in listed equity markets is the bigger you become, the harder it is to perform. Right? Because you get forced into large cap stocks. You can't buy some of the smaller emerging companies within the index and so on. So we're able to have a fund structure that's capped at 40 stocks. So we'll never go more than that. And this, as I said, in a vast universe of 25 countries, that's half of global GDP. So from the very start, if you're trying to build a portfolio of just 40 ideas across half of the global economy, you can set the hurdle rate, the bar, for inclusion in the portfolio very, very high. And so we're only looking for the very, very best companies, and we can be very, very fussy on valuation. No need to chase. We can be patient. So we have high quality companies that we follow that aren't currently in the portfolio. And I think that gives us a tremendous advantage over our peers, most of whom are running 200-300 stock portfolios. And so their top ideas, they probably have high conviction, they're great companies, but they end up owning this long tail of mediocre or low conviction ideas as well. Or, they're toggling around a benchmark. Yeah. So they don't, for example, Turkey, they have a bad view, they have a negative view on Turkey. The currency has been terrible, they don't like the market, but because it's in the benchmark, they end up owning a stock there. It's a low conviction stock. Because we have this high conviction, we can just avoid markets. So we don't have anything currently in South Africa, We don't have anything in Turkey. Russia, classic example last year. Russia was the number one overweight market for EM managers going into the Ukraine crisis. Yep, JP Morgan data, it was the biggest overweight market. The reason was because people were taking a bet on the oil price, and they thought Russia was a good way to express that. We had zero weight in Russia. In fact, we had zero weight in Russia for 5 years before that, because it just for a whole bunch of reasons, which are now apparent, but clearly weren't apparent to some people at the time. But you know, we have the luxury of doing that because we're very, very nimble at 40 stocks. We can rule if markets look unappealing to us. We don't end up forced owners of those low quality assets.
Brilliant. And so do you have sort of, I guess, any countries that are sort of on a red list that you can't own at the moment? And if they are, what gets a company onto that list and what gets it off of that list?
So emerging markets is dynamic. It's always changing. So you never want, Russia was as close to that as possible, but you never want to rule out a market. Right. Because if you rule out a market, now there's plenty of markets where we don't own anything, but we don't want to rule out those markets or put them on a red list because then you stop paying attention to those markets. Right. And if things change, you'll miss opportunities. So classic example, we are very, very underweight China. We don't like China for a whole bunch of reasons currently. And that has a lot to do with the leadership of the Communist Party as it stands today. Empirically, Xi has been very bad for Chinese equities. Right? Whether you think he's a good leader or not, that's beside the point. He's not been good for the equity market. That could change. He could change. We could see a change of leadership in China, a policy that's more friendly to minority shareholders, a cleanup in corporate governance. There's a whole bunch of things that could happen. So we spend a lot of time on China, even though we don't currently like Chinese stocks. And there's other examples of that. So South Africa, we don't have anything in South Africa currently. We haven't had anything in South Africa for a decade. And that's been the right call because that economic risk has manifested in the currency. The rand has been one of the worst performing currencies. So another feature of emerging markets, probably we'll talk about in a minute, is that you've got to be in the right markets. You can't just be a stock picker. And I can explain that in a bit more detail in a second. But with South Africa, nothing. But sure enough, next month one of my colleagues is going to South Africa to see the companies because you don't want to rule anything out. Right? We have our view and we have to constantly test that view. If you go 5-6 years ago, we were very underweight South Korea, and now we're overweight South Korea because we had a change of government, and we have a president in Yoon, the current president, who's quite pro-market, quite pro-minority shareholders. It's improving corporate governance in South Korea, and the equity market looks very cheap. So the world is dynamic, and emerging markets in particular are dynamic. You've got these 25 countries, and there's nothing really that ties them together, right? So South Korea and Taiwan, these are tech powerhouses. So they're the leaders in the semiconductor industry globally. Samsung has the biggest R&D budget of any company in the world. Really? Yep. And Samsung is a leader in foundry and DRAM and ultra high tech computing. And so the same as Taiwan with TSMC. This is in the same index as a country like India or Philippines that are really domestic consumption driven. I mean, in the case of Philippines, half of the country still doesn't have a bank account. Really? Yeah. So these are all mixed in the same index. And that means that in any given year, the range of outcomes is very diverse between countries. So it's not like there's any one factor that impacts emerging markets uniquely. So a high oil price is beneficial for countries like Indonesia, but it's a headwind for India. Right. And it's the same across every single metric you can think of. So that's positive for EM managers if you're nimble, as I said at the start, because it means you could position for any external environment. But what it does mean is you can't just be a stock picker. You've got to be in the right markets. Turkey is a classic example. There's some great companies in Turkey. Corporate governance is the best companies, is amongst the best in the world. And yet, if you've invested in Turkish equities, in local currency, you've probably compounded over the last 15 years about 10% per annum. But in US dollars, you've actually lost money. Really? Because the lira has confiscated all of the gains. Mm-hmm. This is particularly important in emerging markets because it's basically impossible to hedge. Mm-hmm. over a long period of time, you couldn't hedge out that lira risk. It's too expensive, and you've got to keep rolling. You can't get a 15-year currency hedge, right? You've got to keep rolling it every time you're repricing it. And there's other markets like the Taiwanese dollar where it's effectively impossible to hedge. Right. So hedging is not a viable strategy. It's too costly in emerging markets, which means you've got to pick the markets. Now, the flip side of that is if you get the markets right, you actually make money on the currency as well as the equity. So we saw that last year. We had a big overweight to Mexico last year. And 2022 was the year of King Dollar, the US dollar, the almighty US dollar. Actually, last year, the Mexican peso appreciated against the US dollar, went up against the US dollar. So actually, that's a tailwind to your returns. So if you're in the right markets, you make money on the currency and the stocks. And if you're in the wrong markets, the currency confiscates the equity gains.
Brilliant. So there's a few areas I want to jump to, but maybe we'll go straight to the USD because you did sort of talk about that just now. We have seen the US dollar come off. It was very strong last year and it's begun to weaken. What does that mean for emerging markets?
Well, it should be the start of a long period of EM outperformance, if history is any guide. Right. So all of the historic periods of sustained EM outperformance have come amidst a declining US dollar. So in fact, if you look at the US dollar since the Nixon shock of the early 70s, this is where the US dollar broke its gold linkage and became basically a fully floating fiat currency. There's been several US dollar cycles, and the average cycle lasts about 8 years, bull cycle, bear cycle. And the periods of decline in US dollar have always corresponded with a period of strong outperformance for EM equities. Right. So the last one was the period between about 2000, 2001 and the GFC. That was a very, very strong period, an 8-year period of sustained outperformance for EM equities that coincided with a declining dollar. Now, where we are today is, the US dollar has started to weaken, and that's at the end of the longest US dollar bull cycle we've ever seen since that Nixon shock in the early 70s. Yeah, right. So the US dollar was long overdue a period of sustained weakness. And on every metric you can think of, the US dollar looks overvalued. Purchasing power parity, interest rate differential, the length of the cycle, it's long overdue. Now, probably the US dollar cycle should have peaked out last year, arguably, but then we had Ukraine, the geopolitical shock, you had that rush to safe assets amidst that geopolitical tension. You had China's extension right until the end of the year of COVID-0. And so you had a US dollar that was very long in the tooth have another year. And often the final phase of a bull rally, the blow-off phase, is the most strong. And that was last year, King Dollar. So I'm optimistic that US dollar bull market's finished now. And we're going to enter a sustained structural period of US dollar weakness. And as I said, every single time we've seen that in the past, we've seen EM assets outperform DM assets.
Brilliant. So tell us, what do you think the China reopening will mean for emerging markets?
So it was a big surprise. Right? Lots of long-term China watchers. Bill Bishop, who is I think one of the better China watchers, who has a Substack called Sinocism. I think he described it as the biggest surprise in decades of following the Communist Party. Chris Wood, who's arguably the best equity strategist in the world, he said it was the biggest U-turn he's seen in his career. Wow. And he's had a multi-decade career. It was a big surprise because, up until a few weeks before the announcement, the local state-owned press was constantly publishing the need to maintain COVID-0. So, it's clear that this was not a policy that had a long runway. The party's hand was forced. I think the severity of the protests surprised the Communist Party. Also, this is the greatest surveillance state in history. They would have seen rising dissatisfaction with the COVID-0 policy, and so they flipped. And so I think it took many people, even in the senior echelons of the Communist Party, by surprise. Because there's huge cost to this reopening, as we'll see. I mean, it will be hidden, but there will be huge cost in terms of human life given the low level of vaccination, particularly of elderly people in China. But it is what it is. China's opening up. The consumption data is going to take a few quarters to pick up. because it's. I mean, we speak to companies in China on a regular basis. It's pretty chaotic there at the moment, as you would imagine, when you've just suddenly. Because it's not just that the vaccination rate is low in China; it's also natural immunity is low. Right? So pretty much everybody in Sydney has either been vaccinated. Well, has 90% of people have been vaccinated and have had COVID. Right? So you've got a combination of natural immunity and vaccination. In China, there's a lot of people that have neither, because there just hasn't been that much COVID circulating. So it's going to be a painful period. I think there's ways to play reopening. It's happening now. But our preference is not to play it with Chinese companies, but to play it with beneficiaries with better corporate governance. The main issue with mainland Chinese companies is corporate governance is still a level below the rest of emerging markets. So we have a couple of companies in Hong Kong listed with good corporate governance that are beneficiaries. One is AIA, which is the leading insurance company in Asia. The reopening allows... So there's a long history of Chinese going to Hong Kong to purchase life insurance. There's a whole bunch of reasons why they prefer to buy in Hong Kong than China, but it was a big part of AIA's business. I think it was about a third of their business pre-COVID. And so that's kind of, with the closure of the China-Hong Kong border, that's disappeared, that's coming back, so we like that company. And we have a small position in Budweiser APAC, which is the beer company. It's basically, it's the part, like Budweiser's this big global empire, right? ABI InBev. And this is the Asia business. So it's predominantly China, and also has a bit of Korea and some India in there as well. But this, when China does reopen, it probably fully, and by that I mean, although legally China's reopened, a lot of people are self-quarantining at the moment. If you look at mobility statistics, there's still a lot of people staying home because there's just so much COVID around. Right. That's why I said it's going to take a couple of quarters before you see consumption recover. When they do, they're going to go out and they're going to celebrate on-premise, so at bars, restaurants, rather than at home. Yeah. And so the beauty of that, of Budweiser APAC's business, is it's premium. So their beers in China are very premium, much more premium than the local beers. And it's predominantly on-premise in the wealthy coastal cities. So it's a very, very neat reopening play, we think, with good global standards of corporate governance and a discount valuation. So far, there's no change in our long-term view. We're monitoring the situation very carefully. We don't think that this sudden reopening reflects a big change of philosophy of Xi and the leadership. We think really it was just a kind of knee-jerk reaction to that dissatisfaction. So China long-term has some very serious headwinds. So whilst most emerging markets have wonderful demographics, which is one of the big appeals of emerging markets, so you look at the median age in places like Indonesia, India, it's in the 20s. So you're going to get this maturing of the population pyramid that leads to sustained strong growth in consumption, healthcare spend, infrastructure, urbanization, all these beautiful tailwinds to share price performance. China actually has worse demographics than most of the developed world. So the poster child for bad demographics in Asia has been Japan for some time. China's fertility rate is below Japan's. So China's population, on some measures, is expected to contract by half by the end of this century. So there's never really been a big country in history that's going to age as quickly as China is aging now. It seems that the Chinese population's already peaked, the latest data suggests. And like Germany has bad demographics, but bad demographics in China is very different to bad demographics in Germany for one reason, which is that developed countries, and Australia is no exception, have the immigration lever they can pull. Right? So there's excess demand for immigration into Australia, into Western Europe, into North America. China is a relatively unappealing destination for immigration. I mean, that's not my opinion. That's data from the Pews. I mean, because of that surveillance state that the Communist Party has, because it's so dominated by the Han Chinese, language issues, and so on. So there's not really any easy solution that China has to improve those demographics. Now, that's a major headwind to the Chinese economy over that period. Now, the other thing that's going on at the same time is China's really grown over the last 2 decades with fixed asset investment. And the most important part of that has been the property market. Now, if you've built masses and masses of apartments, and China has an overbuild of apartments, and your population's shrinking, that excess capacity actually is getting worse. You can't grow into it. Because household formation at the margin is not really a lever in China as well because of the one-child policy. So you have a very large level of debt in a market that has overspent on fixed assets, particularly infrastructure and property, with poor demographics. And on top of all that, empirically, you might argue that the Communist Party has been good for China's economic growth. You can make that argument. But you cannot make the argument that the Communist Party has been good for the equity market. Right? Over the last 2 decades, China has been arguably the best economic success story in history. Right? The economy has done absolutely fantastic. High single-digit GDP growth consistently. China's brought more people out of absolute poverty than any other scheme in history. The Communist Party has done better than any other scheme in history. And over that 2 decades, over that 20-year period, the equity market's been a lousy place to invest, the Chinese equity market. And the real reason for that is that Chinese companies earn structurally lower returns on invested capital than companies in the rest of the world, companies in the rest of emerging markets. And that's not because management are incompetent. It's because there's multiple goals. If you're running a company in China, if you take the best companies in Thailand, Indonesia, Mexico, India, they're run to grow shareholder value. Right. Same as the best companies in the US and the best companies in Australia. Whereas Chinese companies have these other goals that compete, meeting local GDP targets, meeting fixed asset investment targets, employment targets. Yeah, right. And so they tend to be run from a shareholder value perspective inefficiently. Lower returns on capital. That means ultimately your share price return is just a function of that return on invested capital. And there's not really any reason to be optimistic on that changing in China. If you look at the composition of the Politburo Standing Committee that was announced at the Party Congress in autumn, Chinese autumn last year, I mean, these are all Xi Jinping supporters. Yeah. None of them are going to inject a different opinion. It's a bunch of yes men, frankly. And so there's really very little reason at the moment to be optimistic on that situation changing. Having said that, huge economy, second biggest economy in the world, and with this aging population, there will be opportunities to make money in China. But our preference historically has been to do that by buying emerging market companies elsewhere in Asia with China exposure. So for a very long time, we had exposure to Chinese cosmetics through South Korea. The tech exposure, China basically is now banned from developing its own chip system, but they will still want to buy the leading DRAM, the leading logic chips. They'll have to buy it from TSMC, Samsung. And there's other examples as well of companies that will supply China, the parts of the Chinese economy that are growing, and those will be attractive.
Okay, Ross, so if China's probably not the place that EM investors should be focusing on, what sort of countries and regions do you think look attractive at this time?
So if you think of, our framework broadly in terms of geopolitics is that the US-China relationship is in structural decline. So there's virtually no issues that have bipartisan support in the US. But China, a tough stance on China is one thing that the Republicans and the Democrats agree on, and that's a multi-year. I mean, Biden didn't change that strategy. It wasn't a Trump strategy, it's a US strategy. The flip side of that is there's a beneficiary, a strong beneficiary from that deterioration, and that's Mexico. Right. So if you look at the pickup in FDI in Mexico, if you look at the companies that we speak to that are moving supply chain out of China into Mexico, it's really dramatic. Now, Mexico has a number of benefits. It's in the same time zone. The logistic connectivity with the US rail road connection is very strong. It's part of NAFTA. So it's favorable in terms of tax legislation. If you look at the most the latest legislation in the US, the Inflation Reduction Act, it defines production as North America. Yeah, right. So actually, if you produce in Mexico, you get the tax subsidies. Wow, okay. So Mexico is very important to the US. Right? The US is trying to pivot away from China. It needs an alternative, and Mexico is going to benefit. As one of my colleagues was in Mexico last year, and as one of the CEOs of the company said to him, Mexico is doomed to succeed. Really? Yeah, because they're just the stars are aligned, right? We've seen in the past, like if you look at Japan's history in the post-war period, the US anointed Japan after the Second World War to succeed because they wanted a strong US ally as a counter force to communism, which they saw as the big threat in Asia. And sure enough, there's a story you can tell about the post-war development of the world that was really driven by US geopolitics. Yeah, right. And Mexico is anointed to succeed. The US needs it. So we like Mexico. We're overweight Mexico. As I said, the peso has actually been a tailwind. So it's been a strong equity market, and the currency is helping. Longer term, it's really hard to not like India. India is the anti-China. Great demographics, liberal democracy, companies run for shareholders, and so many attractive sectors. We're looking at healthcare, banking, consumer discretionary. All of these sectors have long tailwinds. And we're not talking the next 5 years, but the next 20 years of growth. So it's a really, really good market. We continue to have an overweight there. And we still like Indonesia. Indonesia as well is a pure, true emerging market. Big population. People forget 260 million. Young population. Yeah. So this is a big young market right on our doorstep. And again, it's the same dynamics. So our biggest exposure in Indonesia is a Bank Central Asia. And they've just got this beautiful tailwind. Mortgage debt to GDP in Australia is about 130%. Probably more. That was last time I checked. In Indonesia, it's low single digit. Right? Wow. So you're investing at the very early stages of financial development. And so this is a bank that's, I had a look actually just last week. The shares have compounded at 26% per annum for 20 years. Wow. If you'd invested in Bank Central Asia in 2000, you've made 232 times your money. Not 232%, it's gone up. It's a 232 bagger. So it's been in our portfolio consistently since 2011, so for a long time, and it's just been a wonderful performance. It looks very, very good. We had a call with management recently. It's just privileged. They have the main deposit franchise in Indonesia. They have cheap funding, and it's really a financial penetration story. So it's not like investing in a bank in Australia or Canada where you're trying to cut cost and loan growth. This is just a loan growth story. And that's just as the population matures. So this is big picture, what we're looking for is the real appeal of emerging markets, which is structural growth. Areas that have a multi-decade tailwind, whether it's urbanization, infrastructure, IT, banking and finance, healthcare, which you just don't get in developed markets.
Brilliant. And so maybe a contrarian bet? Have you got anything that you think other EM managers are sort of missing, a region or even a stock?
Well, China's done very well over the last 6 weeks, 2 months, and lots of managers have been funding that by selling India and Indonesia, right. And I'm happy to take the other side of that, and that's our view is that maybe you'll get a short-term pop because Chinese equities are very cheap. But because we have the ability to look beyond that, our average holding period is more than 3 years. And those long-term headwinds that China faces, they're going to come back to the fore. We're not a believer that the government's done a 180 on its policy against the internet sector, against companies being run purely for shareholders. So that's a contrarian bet. Is that this China recovery is really just a short-term flare.
Okay, fantastic. And maybe we'll finish just with I guess one question on the EM versus developed market outlook. So from here, I'd say you're pretty confident that EMs will outperform DM over the next 3 years.
Yeah, the question mark is geopolitics, right? So I would have taken this bet at the start of last year, right. Before Ukraine. I mean, we didn't have anything in Russia. But the time was right for a long period of EM outperformance. And then Ukraine happened and we had this, rush to safety. My conviction is higher now because I think there's a few things that are different. US equities look, even with the sell-off, they look still overvalued. I think analyst estimates in the US are still too optimistic. You still need to see earnings downgrades. I'm happy to take the bet that on a 5+ year view from now, EM will outperform DM. I think the conditions are set for a period of sustained EM outperformance. Timing is difficult, but yeah.
All right, brilliant. We'll probably wrap it up there. Thank you very much, Ross. We really appreciate it.
Great, great questions. Thank you.
Thank you, Ross.